Hello students, welcome back. This is Dr. Mercado speaking. Welcome to another lecture for our Accounting 2401 Principles of Financial Accounting class. In this lecture we are going to be covering Chapter 9, which deals with long-term assets, fixed and intangible. And in this particular lecture I am going to be going over problem 9-2A. It is very important that before you begin working any of your assignments that you read over the entire chapter. Okay, you're going to have a variety of basic exercises, and exercises, they're very simple. I am focusing my lectures on the more complex problems. These are the ones you're going to more likely see on your exam. That is why I'm taking the time to cover them with you. Okay, so the majority of your problems have a show me how video embedded in them within Cengage. That way you have something to refer back to, along with the examples on your textbook. But if you have any questions or concerns as you are working your assignments, do not hesitate to reach out to me. Please refer to your course syllabus for my scheduled office hours. Okay, so let's begin. In this particular lecture, I am going to be covering depreciation. 3 methods of depreciation are going to be covered. Now, depreciation is basically accounting for the use of an asset. An asset is purchased, it's being used, it is losing value. Just like when you purchase a vehicle, you buy a brand new car, you start driving it, and it begins losing value as soon as you drive it out of the dealership. Okay, the more miles it has, the more it depreciates. Okay, so according to the textbook, recording the cost of fixed assets as an expense is called depreciation. Okay, we depreciate most of our assets with the exception of land. Land is not depreciated. Okay, and it is very important to note that depreciation does not necessarily measure a decline in the market value of an asset, but rather depreciation is just an allocation of a fixed asset's cost to expense over the useful life of the asset. So it's a way of depreciating an asset. We have to recognize that the asset is losing value because it is being used, and there's different methods to be able to allocate that value. The depreciation has nothing to do with the market value of an asset. Okay, the book value is basically the cost of the asset less the accumulated depreciation. That book value is how much that asset is worth in our books. Okay, so if you're planning on upgrading an asset, selling an asset, acquiring a new asset, or whatever the case might be, you always need to look at that book value. Okay, because that is how much that asset is worth in our books. Okay, there's several factors that we have to take into consideration when depreciating an asset. Okay, the 3 factors that we have to determine in the calculation of depreciation expense is the asset's initial cost, the asset's expected useful life, how long is this asset going to last us for, and the asset's estimated residual value. Okay, so what is residual value? Okay, residual value of a fixed asset is basically the estimated value of the asset at its end of its useful life. So let's say you buy a car, you're going to depreciate it over 5 years. At the end of those 5 years, is that car worth something? Okay, if you think that that car is worth something, you're going to be able to sell it for $3,000, then that residual value will be those $3,000. Okay, it is basically an estimate at the time the asset is placed into service of how you anticipate that asset. Is it going to last us? If it is, will that asset have a value at the end of its use? Okay, residual value is referred to as scrap value, salvage value, or the trade-in value. Okay, so a lot of businesses, they buy cars, because they need vehicles, to transport goods or whatever. So they look at the cars and they say, okay, every 5 years I'm going to get a new car. Okay, and the residual value plays a big impact. You know what? If I trade in this car at the end of the 5 years to buy a new car, is that car going to be worth something? Am I going to get something for that car? Okay, if the answer is yes, then you take into account a residual value. Most of the places that I have worked for in the past, the residual value is 0, which means they depreciate the asset in full. Okay, if they get something out of that asset, well, good. But if they don't, the asset has been fully depreciated. Okay, so the difference between the asset's initial cost and the residual value is called the asset's depreciable cost. That is the actual amount that you're going to depreciate over the period of time that you're expecting the asset to be good for. Okay, so this is the asset's cost that is allocated over its useful life. Okay, now in this particular problem, I like it because it basically we are going to be accounting for depreciation using the three methods. We're going to do the straight line method, the units of activity method, and the double declining balance method. Now, a lot of businesses use the straight line method because it's the simplest form of depreciation. It's very simple to calculate, and it's basically the same fixed amount month over month for that specific asset. So, the straight line method provides the same amount of depreciation expense for each year of the useful asset of the asset, okay? The annual straight line depreciation is basically the formula is the cost minus the residual value over the useful life. So first you get the cost. If there's any residual value associated, you deduct that to get the depreciable cost, and then you divide over the useful life, and that will give you your annual depreciation. Now, mind you, here in the book, they're doing annual depreciation. In real life, we depreciate assets usually on a monthly basis, okay? But whatever the example is, if you're going to be doing it over months, instead of doing 5 years, you might want to do 60 months, okay? Whatever the case might be, you still want to get that standard amount, okay? Next, we have the units of activity method, okay? The units of activity method basically provides the same amount of depreciation expense for each unit of activity. So here we're tied to an actual activity, okay? Depending on the asset, the units of activity can be expressed either in hours, miles driven, or quantity produced, okay? So it just depends the type of business that you're running. If you have vehicles, if you have machinery, what is it that you have? How are you going to identify how you're going to depreciate that asset, okay? So they give you an example that usually for a truck, the driver in depreciation is going to be the miles driven. For manufacturing assets, those maquiladoras that have those big machines, usually the units of activity are expressed as units of product, okay? So there's 2 steps associated with determining the depreciation for units of activity. Step 1 is determine the depreciation per calculate the depreciation per unit. You're going to get the cost minus the residual value, which gives you the depreciable cost, divided by the total estimated units of activity. Okay, so it's very similar to the straight line, but the instead of dividing by the useful life, we're going to divide by the estimated units of activity. Okay, now the more complex one is the double declining balance method. Okay, the double declining balance method is more aggressive. It provides for a declining periodic expense over the expected useful life of the asset. And there's 3 steps. Okay, with this method, you're going to be depreciating the majority of the expense at the beginning of the term. Towards the last couple of years, you're going to have less depreciation. Okay. So for step number 1, you're going to determine the straight line percentage using the expected useful life. Step number 2, you're going to determine the double declining balance rate by multiplying the straight line rate, and then you're going to compute the depreciation expense by multiplying the double declining balance rate times the book value of the asset. Okay, now very important when we are using the double declining balance method, the estimated residual value is not considered. So the basis is always going to be the cost. Okay, you're not deducting the residual value. For straight line and units of activity, we deduct residual value. For the double declining balance, the residual value is not considered. However, the asset should not be depreciated below its estimated residual value. So we don't take it into account at the beginning of the calculation, but when we are depreciating our asset, we need to ensure that we stop depreciating it at that residual value. Okay? And there's examples in the book that provide you all of this, so make sure that you do refer to your book. This is not an exemption. You know what? Well, I listened to her lecture. I'm not going to read. No, that's not how it works. You need to read and then listen to my lectures, okay? So let's dive into the problem. We've got problem 9-2A, and it's basically comparing 3 depreciation methods. Okay, it says Dexter Industries purchased packaging equipment on January the 8th for $81,900. The equipment was expected to have a useful life of 3 years or 20,000 operating hours. and a residual value of $4,500. The equipment was used for 7,600 hours during year 1, 6,000 hours in year 2, and 6,400 hours in year 3. So we have to determine the depreciation expense for the 3 years ending December the 31st by the straight line method, the units of activity method, and the double declining balance method. We also have to determine the total depreciation expense for the 3 years by each method. Okay? The 4 columnar headings are suggested for recording the depreciation expense amounts. So I basically set it up the same way. Okay? And then they're asking which method yields the highest depreciation expense for year 1, and then which method yields the most depreciation expense over the 3-year period. Okay? So let's begin our calculation with the straight line method. Okay? So let's go back and review straight line method. For the straight line method, we're going to get the cost minus the residual value over the useful life. Okay? Cost minus residual value over useful life. Okay? So in this particular case, we've got the cost of $81,900 minus the residual value. According to this, we have a residual value of $4,500. And we're going to divide by the useful life, which is 3 years. Okay? So let's see what that gives us. Okay? So we've got 81,900 cost minus residual value of 4,500. It gives me 77,400 divided by 3 years. That gives me an annual depreciation expense of $25,800. Okay? $25,800 each year. Okay? So now I can fill that in. Straight line depreciation will be the same amount every year. Straight line, which means it doesn't change. Okay? So that is what's going to happen for straight line. So we're using the same amount because we're depreciating the depreciable cost over the 3-year period. So every amount will be the same for every year. Okay? So that's when you're doing a straight line depreciation, all of the amounts should be the same for every year. Okay? So now let's look at the units of activity method. What are we going to do there? On the units of activity method, we basically have 2 steps. We're going to get the cost minus the residual value over the total estimated units of activity. Okay? And then once we figure that out, we can calculate the depreciation expense by getting the depreciation per unit times the units of activity per period. Okay? So in step number 1, we're calculating the depreciation per unit, and then we're going to multiply the activity for that specific period. Okay, so let's do step number 1. Okay, step 1, we're going to go ahead and we're going to calculate. So we have the cost of $81,900. We're going to deduct the residual value of $4,500. Okay, and we're going to divide. It says here that the equipment is expected to have a useful life of 3 years or 20,000 operating hours. So we're doing it based on the operating hours. So we're going to divide by 20,000 operating hours. Operating hours. Here we go. And let's see what that gives us. So 81,900 minus 4,500, that gives me 77,400, and I'm going to divide it by 20,000 operating hours. So that gives me $3.87 per hour. Okay? 3.87 per hour. Okay? Now that we have that, we can calculate year 1, year 2, and year 3. So, the important thing is that we calculate that 387 per hour, okay? Now that we have that 387, we can go ahead and we're going to get, if we go back, we're going to get the depreciation per unit, which is what we just calculated, and we're going to multiply it by the units of activity for that period, okay? So we're going to start off with the 387 per hour, and we're going to multiply it. Now it says here that on the first year, we use the equipment 7,600 hours. Okay, so let's see what that gives us. 387 times 7,600 hours, that gives me 29,412. Okay, that's going to be my depreciation for year 2. For year 1, I'm sorry. For year 2, we're going to once again start with the 387 per hour. And in year 2, we use the equipment for 6,000 hours. Okay, so this ties to the actual usage of the equipment. Okay, which better aligns than just depreciating it straight line. If we use it more 1 year, then the depreciation is going to be higher. If we use it less, it's going to be lower. Okay, so 387 times 6,000, that's going to give me 23,220. Okay, 23,220. And then last but not least, once again, we're going to start off with the 387. And in year number 3, we use the equipment 6,400 hours. Okay, so then that's going to give us 387 times 6,400. That will give me 24,768. Okay, 24,768. Here we go. So now we transfer that over to our table. That way we can do a comparison. Okay, so we've got the 29,412, the 23,220, and the 24,768. We're going to add those together and let's see what it gives us. Okay, the same, 77,400. Okay. Okay, so now let's look at the double declining balance. Okay, so the double declining basically says to determine the straight line percentage using the expected useful life. Okay, so let's do that in step number 1. We have to calculate that, and then once we figure that out, we're going to go ahead and we're going to multiply that by 2. Okay, and then we're going to go ahead and compute the depreciation by multiplying the double declining balance rate from step 2 times the book value of the asset. Okay, now this is very simple per se because we only have 3 years. Okay, so in year number 1, what we're basically going to do is we're going to get the year 1. Let me get here year 1. Okay, so what are we going to start off with? We're going to start off with the costs of the asset. Remember, we do not take into account the salvage value because we're doing the double declining balance. Okay, so we're going to go ahead and we're going to get the 81,900, and we have to get double the rate of the depreciation for that year. So we're basically doing, okay, so we're doing double the rate. We have 3 years, so we're going to double that. That means we're going to do 2 out of the 3 years. Okay, so we have 3 years in total. We have to double that first year. So 1 times 2 gives me 2. So my rate will be 2 over 3. Okay, 2 over 3. Okay, and let's see what that gives us. So we're basically doubling the depreciation that first month. Okay, 81,900 times 2 over 3 will give me $54,600. Okay, so year 1 is going to have a pretty high depreciation amount. Okay, and we're doing 2 over 3 is because we have 3 years. We have to double the year number 1. So 1 times 2 gives me double the first year. So 1 times 2 gives you 2, and then you divide by the total number of years, which is 3 years. So the 2 is basically double the first year's depreciation. Okay, now for year 2, we're going to go ahead, and this is where it becomes a little bit more complicated. We're going to go ahead and we're going to get the cost of 81,900, and we're going to subtract the depreciation for year number 1 that you calculated, which is 54,600. Okay, and then once again, you're going to multiply by 2 over 3. That's going to be your depreciation rate. Okay, so 81,900 and then you're going to subtract what you depreciated already the first year. That leaves you $27,300, which is what you're going to depreciate in year number 2. And you're going to depreciate it at 2 over 3. That's going to give you a depreciation of $18,200. Okay? Okay. Now, year number 3 is complicated. Why? Because if you recall here, the double declining balance method does not consider the residual value at the initial calculation. However, the asset should not be depreciated below its estimated residual value. When you get to that last year of depreciation, you have to remember, okay? You have to remember, you know what? This is the last year of depreciation and I can't go below my salvage value. So what are we going to do is we're going to go ahead and we're going to get the 81,900. I'm going to subtract the depreciation for year number 1, which is 54,600. I'm going to deduct the depreciation for year number 2, which is 18,200. Okay, and I am going to subtract my salvage value of $4,500. On that last and final year, you have to deduct your salvage value on that last calculation, okay? Because we need to make sure that we don't depreciate past that amount, okay? So when you get to your final year of depreciating using the double declining balance method, you get the cost minus the depreciation for year 1, the depreciation for year 2, minus the salvage value. Okay, and let's see what that gives us. So it'll be 81,900, the cost, minus the depreciation for year 1, minus the depreciation for year 2, minus the salvage value. That means that this year I'm going to depreciate my asset $4,600. Okay. Okay, so now I can enter that into my sheet. And let's get a total. So just remember, this is the double declining balance is the more complex one. Just remember in that final year when you're deducting the depreciation for years 1 and years 2, you also take into account by deducting if there's any salvage value. If there's a salvage value, you need to deduct it to be able to calculate your final depreciation for that year. Okay? So these are all of the calculations. We've entered them into our table. Now question number 2 says, which method yields the highest depreciation for year 1? So if we notice, the highest depreciation will be the double declining balance method. Why? Because just like the title states, you're depreciating at double the rate. So you're depreciating much faster. Okay? So basically, let me just get my calculator here. 20. Okay, so it's basically calculating at a more aggressive rate the first couple of years, and then towards the last couple of years, the depreciation expense will be lower for the double declining balance. Okay, so what method yields the highest depreciation? The double declining. What method yields the most depreciation? And if we notice, all 3 methods yield the same amount of depreciation as it should be. We're not changing the depreciation amount. All we're doing is changing the allocation of the depreciation over the 3 years. Straight line, same amount all 3 years. Units of activity, it's based on the actual usage of the equipment. Double declining balance is a more aggressive approach, basically doubling the rate of the straight line calculation without taking into account the residual value. Remember, straight line method, we deduct the residual value. Double declining, we don't at the initial phase. Okay, so these are the 3 calculations step by step. I hope that this helps you complete your homework problem. Like I stated, if you have questions or concerns, do not hesitate to let me know. But please make sure that you read the chapter. And if you do have questions or concerns, When you send me an email or a Blackboard message, make sure that you include the problem number that you're working on, your name, the class that you're in, as well as your attempted solution. That way I can review your work step by step and provide guidance. Okay? So that is basically all that I have for you today. I hope you have a wonderful rest of your week, and until next time, thank you.